Hey everyone, welcome back to Corporate Dakota, the place where we learn that sometimes the most important business decisions are made not in fancy boardrooms, but through a bit of sneaky shareholder consent. In our latest deep dive, we are unraveling a document from FOXO Technologies Incorporated. This isn't your typical quarterly report, it is more like a behind. The scenes look at some pretty significant corporate actions that have already happened. We're talking about big changes to the company's stock structure and the people in charge. So what exactly is going on at FOXO Technologies Incorporated? Well, it turns out their board and a major shareholder have been busy. They decided to increase the number of authorized shares of Class, a common stock, from 2.5 billion to a whopping 10 billion. They also doubled the authorized preferred stock from 10 million to 20 million shares. Think of it like this. They are making a lot more IS for company ownership available. This move was approved by a shareholder who controls a majority of the voting power. This is important because it means they did not need to call a full shareholder meeting. They just got a big player to sign off. This happened through a written consent in lieu of a meeting, which is a fancy way of saying they got the main owner to agree in writing without everyone having to get together. Now, why would a company want to drastically increase its authorized shares? It usually boils down to needing flexibility for future plans. The company says they need these extra shares for a few reasons. First, to cover potential conversions of their existing preferred stock and convertible debt. That means people holding certain types of company debt or special stocks might be able to swap them for regular common stock. If they do, the company needs to have enough common stock ready to hand out. Second, they have issued warrants, which are basically options to buy shares at a set price. If these warrants are exercised, more shares will be needed. And third, they want to have shares available for future financing rounds where they might sell more stock to raise money, or for things like employee stock options to attract and keep talented people. They also mention strategic transactions like acquisitions, where they might use stock as payment. But it is not just about the money and shares. This filing also confirms the re-election of 5 directors: Seamus Lagan, Trevor Langley, Francis Colt III, Brett Barnes, and Mark White. These folks will serve until the next annual meeting, essentially. The existing leadership team is staying put. The board itself also gave its nod to this plan to increase the authorized shares. They did this unanimously, and before the major shareholder gave their consent. It seems like there was a coordinated effort here. Let's look at the numbers. As of the 16th of December 2025, FOXO Technologies had over 1.7 billion shares of common stock already issued and outstanding. That is a lot. And they have several types of preferred stock too, with various designated and issued shares. The big takeaway is they are running low on authorized shares and need this increase to keep operations going or pursuing opportunities. The company emphasizes that this move is in the best interest of the company and its stockholders. Of course they would say that. But let's get real about what this means. A massive increase in authorized shares can be a double-edged sword. On one hand, it gives the company the freedom to raise capital, make acquisitions, or reward employees. On the other hand, it can lead to significant dilution for existing shareholders. If a lot of new shares are issued, your percentage of ownership in the company goes down. When it comes to preferred stock, the board has a lot of power. They can issue these shares in different series, each with its own special rights regarding dividends, conversion, voting, and more. This can be used to attract specific investors, but also, and this is where it gets interesting, to get in the way of a takeover. By issuing preferred stock with rights that make a company less attractive to an acquirer, the board can effectively deter unwanted advances. The company acknowledges this, stating the increase could facilitate future efforts by us to deter or prevent changes in control of the company. Now, let's talk about the money folks, the auditors. The majority shareholder also ratified the appointment of Crete and Chu CPA LIP as the company's independent registered public accounting firm for the fiscal year ending the 31st of December 2025. This is a routine, but essential step to ensure financial accountability. Looking at the accountant fees, the company spent $666,550 on audit fees in 2024 and $373,236 in 2023. They also incurred some audit-related fees. While these numbers are significant, what is more important is that the audit committee is responsible for reviewing these services and ensuring the auditors remain independent. They seem to be following the rules there. Let's peek at who actually owns the company. As of the record date, Renova Health Incorporated, headed by Seamus Lagan, holds a significant chunk. Seamus Lagan himself, as CEO, has some shares, as do other directors and officers, but the true power lies with those who control a large percentage of the voting stock. The filing highlights that due to voting agreements, Renova Health Incorporated's voting power is substantial, What is important here is understanding who has the real say. When you see these voting agreements, it shows a concentration of power. This is why a shareholder with a majority of voting control could push through these changes without a full shareholder meeting. The filing states that unless otherwise indicated, no officer, director, or major shareholder has any substantial interest in these approvals beyond their role. As such, this is standard corporate language, essentially saying that the decisions were made for the good of the company as a whole, not for personal enrichment beyond their normal compensation. Of course, like any SEC filing, there is a whole section warning about forward-looking statements. This is basically the company saying, we're making educated guesses about the future, but the actual results could be very different. It's important to remember that these projections are not guarantees. And then we get to the housekeeping. There is information on how they handle mailings to shareholders, how to get more information, where to find their filings, all the important stuff that keeps the corporate machinery running smoothly, but isn't exactly a headline grabber. So what is the story here? FOXO Technologies is essentially getting its house in order to have more financial flexibility. They've massively increased their authorized shares to make sure they can pursue future financing, reward employees, and potentially make acquisitions. They've also reaffirmed their current leadership team. The fact that this was done via written consent highlights the power of major shareholders in today's corporate landscape. Now, for my take, on one hand, the company needs the flexibility, and the increased share authorization is a way to get it. It shows they are planning for growth and have strategies in mind that require capital or stock-based transactions. The fact that the majority shareholder and the board are aligned is also a positive sign for execution. However, the massive increase in authorized shares from 2.5 billion to 10 billion common shares is a huge potential for dilution, while they say it is for future financing and obligations. Existing shareholders should be watching very closely how these new shares are actually used. If they are issued too cheaply or too frequently, it could significantly reduce the value of their holdings. The company is also leaving itself open to using these shares for anti-takeover measures, which might not always be in the best interest of all shareholders, especially if a premium offer is on the table. The direction of the company seems to be focused on expansion and securing future resources, which is a necessary part of growth. The key risk is managing dilution and ensuring new shares are issued at favorable terms. An opportunity lies in executing their growth strategies effectively with the newly available capital. The leadership seems stable, but the real test will be in how they deploy this increased share capital. Alright, that is our breakdown of FOXO Technologies Incorporated's latest filing. What is your take on these massive share authorization increases and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.